Well, hello and welcome back to Principles of Accounting 1. I am still your host, Dr. B. Happy to have all of you with me as always. I sincerely want to say that I appreciate all of your efforts that you've made in this course so far. All of you have been doing a wonderful job with staying on top of the work. And I know that that's no small feat. This course is very busy. There's a lot going on every week. There's a lot to learn, a lot of ground to cover. And I just want to sincerely say I appreciate you and your efforts. Every Thursday, I see you all in the classroom completing the work. I know it's due on Sunday, but I appreciate you doing it on Thursday. The reason for that is you have the extra time to do the work, and it gives you the opportunity to try it for the first time. And what that means is, with every homework assignment and every quiz, you know that there's that second attempt. And with that second attempt, you can try it again, especially if you didn't do well the first time around. And having the time to do that, I think, is good. So, again, I appreciate all of you. Appreciate your hard work. And anytime you need help, you can always email me, call me, set up office hours. I want you to know I am here for you and for your success. So please, you ever need anything, get in touch with me. And with that, we'll go ahead and get started. For those of you who are following along here in the classroom, we are in Module 1. We made it all the way to week 4. That's awesome. Very happy about this. For this week, after today's lecture, you'll have a discussion board, which some of you have already started participating in, and I really do appreciate that. That discussion board is your homework for this week. Now, I want you to understand this. Discussion board is worth 5 points. That's 5% of your total grade. Please make sure that you participate in this discussion board. It is required. Not only is it required, I expect full paragraph responses, and please include citations and references. You don't need to be an expert in APA format. Okay, I'm not looking for expertise. I am looking for your ability to cite and reference. Okay, if you need help with that, just let me know. I'll be happy to help you out. But it's important that you cite and reference. And I'm just looking at these now. So if this is you, Tamara, if this is you, I just want to say this is really good. I see the in-text citation here, and I see the reference here. This is exactly correct. This is APA format. Very well done. I see a couple of paragraphs. This is exactly what I'm looking for. Okay. Format like this, couple of paragraphs, responding to the discussion post. Discussion post, which is due this Sunday night, but I want you to please, again, Thursday, make sure your original posts are completed by Thursday, so that way it'll allow you time to respond to 2 of your classmates Sunday night. Damon, please, I see your hand.
Oh yes, the discussion post. I overlooked that. How many discussion posts have we had so far that we're supposed to have completed?
This is the first one that's required, Damon. So,
The first one, okay.
yep, this is the first one that's required. So chapter 4, there's a discussion, and then I think that there's one toward the middle of the semester, if I'm not mistaken. But this one's the first one that's required.
Okay.
So yeah, you're okay. No worries there. What I'm looking for is a discussion on why are closing entries prepared? Why do we use income summary? Why are closing entries prepared after the financial statements? These are the 3 questions I'm looking for you to answer. Ideally, if you could do like what Tamara did with a paragraph a question and a response, that's great. Okay. It doesn't have to be super long, but as long as you answer these 3 questions in a logical way, using citations and references, excellent. You can use outside resources if you want to, which means you could hop on your favorite search engine, take a look for outside resources, just search closing entries. Why are they prepared? If you search for these questions, there's going to be a whole lot of results, and you're more than welcome to use those. Okay, just make sure that you cite and reference them. Ideally, your textbook, and the PowerPoint presentation and today's lecture will certainly help you to answer these 3 questions. So again, full paragraph responses, citations, and reference. I'd like you to please have your original post completed by Thursday night. Then please respond to 2 of your classmates. Okay, that's what makes a really good discussion, is that you all act as a community. Yeah, this is a class. A class, in my mind, is like a community. Okay? And having that sense of community is really important to me. So all of us involved with each other, talking to each other about things like closing entries, it's a great way for us to get to know each other and to work with each other. Yeah. So please make sure you complete this. It's worth 5% of your grade. That's a big amount. Yeah. So please make sure that you do this. And I sincerely appreciate it. Okay, so with that, let's talk about this concept called closing entries through completing the accounting cycle of the presentation. We're going to talk about how the closing process works. We'll talk about the accounting cycle, which you've already been working through over the past 3 weeks. And of course, we'll finish up with some of your favorite ratios. It'll be short, sweet, and simple, I promise you. But first, I'll talk about this thing called a worksheet. A worksheet is kind of like an Excel spreadsheet. That's what a worksheet is. Very simply put. It doesn't get filed. It's only used by accountants to help the accountants to understand if there was an error. It looks at things like financial statements, income statement, balance sheet, statement of cash flows, statement of retained earnings. Looks at those financial statements, and the worksheet helps us identify any errors in the transactions. The worksheet, we use it at the end of the accounting cycle, before we do our closing transactions, and during the time that we do our adjusting entries. I talked about adjusting entries a little bit last week. That's what a worksheet does for us. Helps us to identify any kind of errors that we may have made before, during, and after we've done our adjusting entries. It helps us to have a snapshot of the information between the unadjusted trial balance, the adjusting entries, and then, of course, the adjusted trial balance. That's what a worksheet does for us. Very simple. It's not a required report, but it's just a nice way to put things together and a visual effort to help us to see any errors. That's what a worksheet is. Again, it's like an Excel spreadsheet that accountants use to identify any errors that may have happened. It's the basis of it. It's not a required step, but it does help. 5 steps for using a worksheet. First step is to Enter the unadjusted trial balance. Here's what this is. An unadjusted trial balance is a list of all the accounts, starting with the balance sheet, cash, accounts receivable, property, plant, and equipment, all your assets, right? Then below that are all your liability accounts, accounts payable, wages payable, anything payable. And then, of course, anything like unearned revenue, notes payable, etc. So assets, liabilities, and then your equity accounts. Things like paid-in capital, owner's withdrawals, etc. And then below that are going to be your revenue accounts, the income statement, sales. And below that are all your expenses, rent expense, wage expense, utilities expense, all the day-to-day expenses, right? Everything's listed out based off of the chart of accounts. So first thing we do is we list everything on the left side, and we enter in their balances. Whatever their balances are, that we enter those in as well. That's called the unadjusted trial balance. So it's the raw balances for every single account on our chart of accounts listed out. The second step of using the worksheet is to enter the adjusting entries. Adjusting entries, just like we talked about last week, are journal entries that we make to adjust for consumption of items that have happened throughout the month. An example of this would be prepaid insurance. We paid our insurance in advance for 2 years. Okay? $400 for the example from last week. We prepaid our insurance for 2 years. The total cost was $2,400. According to accrual-based accounting, I need to make an adjusting entry at the end of each month to recognize the expense during the time that has been consumed. The matching principle, yes? So in this case, I make an adjusting entry. I debit insurance expense to increase my expense. And I credit prepaid insurance to reduce the prepaid insurance account. What I've done there is called an adjusting entry. I've recognized we've consumed the month of insurance expense. I make that adjustment at the end of each month. I do that for other adjusting entries for various things, right? Because ultimately the reason why we make adjusting entries is we're recognizing the consumption of something, whether it be something like prepaid insurance or other prepaid accounts. Maybe it's revenue. We went from unearned revenue to earned revenue. So in that case, we would debit unearned revenue and credit revenue, for example. That's another adjusting entry we would make. Another example would be adjusting for their liabilities for whatever reason, bank transactions, or bank fees, I should say, that show up on your bank statement. We do those in adjusting entries. Interest accruals, those are adjusting entries, etc. We do that in order to make our books match what's on the bank statement. That's step 2. And we do that in the column right next to the the unadjusted trial balance. I'll show you a visual of this here in a second. Step 3 is to prepare the adjusted trial balance. This part is very simple. All we're doing is we're taking the balance from the unadjusted trial balance, then adding or subtracting based off of the adjusting entries from step 2. Get the adjusted balance. Right? So you take the unadjusted balance amount plus or minus the adjusted column, if there is anything. Then that equals the adjusted balance amount. Think of it like the ending balance. Yeah, the adjusted trial balance, that's kind of like the ending balance, or what it should be, ending balance. And step 4 is to sort the adjusted trial balance amounts to the financial statements. Step 5 is the statement columns compute income or loss and balance columns. I know, it's a mouthful. I'll show you what it looks like. It's very easy. Here it is. Here are your 5 steps. Step 1, the unadjusted trial balance amounts. You see, as I had said, on the left side, we list out all the accounts from the chart of accounts, starting with our balance sheet accounts and then moving into our income statement accounts. The unadjusted trial balance amount is like the raw balance. Yeah, that's why it's unadjusted. 4 adjusting entries. Step 2, the yellowish color there, the middle one, for adjustments. Those represent the adjusting entries we made at the end of the month. Step 3, in the blue, the middle right, adjusted trial balance. You can see that the adjusted trial balance reflects the unadjusted trial balance amount plus or minus the adjustments that have been made to that account. For example, let's look at supplies. Number 126. Supplies, the unadjusted trial balance amount was $9,720. According to transaction B, I used some supplies of $1,050. Therefore, my adjusted trial balance amount is $8,670. $8,670 came from, of course, $9,720 minus $1,050. Gives us $8,670. Cool, nice and easy. And we do that for each account. If there were no adjustments, no problem. It's this going to be the same amount as it was unadjusted because there were no adjustments. Right? Just like as we see with the cash balance. So that's step 3. Step 4, reconcile to the financial statements, income statement, balance sheet, and statement of owner's equity. The reconciliation process, we're just simply posting the unadjusted trial balance to the income statement and the balance sheet and the statement of owner's equity. Then lastly, step 5, at the very bottom, we have net income and our totals. A couple of areas of observation here. On the income statement, after our total, we add in net income to get our final total. If it's a net loss, we subtract it. And what we're also doing is we're making sure that our debit column equals our credit column. Because remember, your debits must also always equal your credits. That's the point of using a worksheet, just like this. It's an Excel spreadsheet, all the accounts listed out, and we go through this 5 steps. It's not required that you do this in your job if you're an accountant, but it does certainly help to validate that thing balances correctly. That's why we use a worksheet. Worksheet is close to the end of the accounting cycle, and we'll talk about the accounting cycle here in a little bit more. One of the last things we do in the accounting cycle is we close our temporary accounts out. I mentioned, I think it was either last week or the week before. In the week before, actually. We start every month with 0 revenue and 0 expenses on our income statement. So today just so happens to be January 31st, 2023. Tomorrow morning, when I open up my QuickBooks, there's not going to be any revenue. There's not going to be any expenses for the month of February. February just started tomorrow. Okay? February just started tomorrow. I'm not going to start February with the revenue and expenses. It's impossible. You can't start February 1 with a bunch of revenue and expenses. They haven't happened yet. Your income statement accounts are called temporary accounts. The reason why they're temporary is because at the end of every accounting cycle and every month, we close those accounts. We transfer their balances. Those balances get transferred from the income statement to the balance sheet through a closing process. The way it works is we close out our revenue to an account called income summary. The name income summary is a summary of the income. That's where it gets the name. Then we close out our expense accounts to income summary. Because remember, the word income summary means a summary of the income. Revenue minus expenses equals net income, which is a summary of the income. So I closed my revenue. I closed out my expenses to this account called income summary. I close that out, income summary, to retained earnings. Retained earnings, that's a permanent account. That's an equity account. So through that process, I used income summary as like an intermediary in the middle. Revenue and expenses go into income summary, and then income summary goes to retained earnings. That's how I transfer my revenue and expenses onto my balance sheet through that process. That's called closing the temporary accounts. That's why at the beginning of every single month, I start out with 0 revenue and 0 expenses on my income statement because of that process. Let's talk about that a little bit more in detail. Temporary accounts, again, are your revenue and expenses, both of which are found in the income statement. Additionally, temporary accounts include withdrawals in that account we just talked about called income summary. Income summary is like an intermediary account. It has a balance for a little bit, and that gets transferred to the permanent account called retained earnings. On the permanent side of things, your balance sheet. You're always going to have a balance in your asset accounts. We don't close your bank account every month and then open a new one. No, that'd be silly. The cash is always going to be there, right? So the cash is there. The same with your accounts receivable. Your customers still owe you money. Just because it's a new month doesn't mean they don't owe you money. So your accounts receivable is still going to be there. Your property, plant, and equipment, that didn't go anywhere, so there's still a balance there. Those are permanent accounts. They're on the balance sheet. Liabilities. I still owe bills. Those didn't go anywhere at the end of the month. They're still there. Liabilities are permanent accounts. Accounts payable, wages payable, still got to pay the employees, still got to pay those loans. All your liabilities are still there. Those are permanent accounts. Now, of course, your owner's equity, your equity accounts, capital accounts, those are permanent. Those don't go anywhere. So that's the difference between temporary accounts and permanent accounts. Temporary accounts, we close those out at the end of every single month. They're temporary. I can't go into February 1 with revenue and expenses on my income statement because those don't belong to February, they belong to January. So tonight, when I go through my closing process, I'm going to make these adjusting entries. I'm going to go through the process of transferring everything to income summary. My revenue and expenses, transfer those to income summary. Now I'm going to transfer income summary to retained earnings. I'm going to subtract out any withdrawals that the owner may have made. And all that ends up as retained earnings. Retained earnings is a permanent account. So that's the process. Closing entries. So how do we do it? First, we need to, of course, identify the accounts we need to close. We need to close all of our sales, revenue accounts, all of our expenses, any withdrawals. Remember, revenue and expenses are always on your income statement. That means every single month, at the end of every month, you're closing out your income statement accounts, making them zero. So that way, starting February 1, you start fresh. Start the month fresh with no sales and no expenses. Withdrawals, that comes from your owner's withdrawals, and that's on the statement of owner's equity. So step 1, identify the accounts we need to close. Step 2, record and post the entries. Let me show you what those look like here in a second. So this helps us to close out our revenue expenses to income summary. Okay, that's what recording and posting entries means. I'll show you how to do that. Pretty easy. And then step 3 is to prepare the post-closing report, if you will. Basically all that means is we're finalizing our financial statements. Let me show you how to prepare those closing entries. This is so important because we need to start the beginning of every month fresh. Okay? We can't have revenue or expenses on our income statement at the beginning of the next month. Tomorrow morning, my revenue is 0, my expenses are 0. Because for February, it just started. I didn't accrue any revenue or expenses yet. I didn't earn anything yet. Month just started. So, here are the entries we make. To close out our revenue, to close out the revenue, debit revenue, and credit income summary. Think of it like the reverse. Okay, when we record revenue, when we've earned revenue, we debit cash or accounts receivable, whatever, And then we credit revenue, recognize the sale. That's the transaction we make when we recognize the sale. I debit cash or accounts receivable or whatever, and I credit revenue. It means I made a sale. Now here we are at the end of the month. I got to close out my revenue account. So to do that, I'm going to debit revenue. That same amount. And credit income summary. What that does is I'm transferring the amount of revenue, putting it into income summary. Income summary is a temporary holding account that I use to transfer over to owner's equity. So first thing I'll do, close out the revenue. By debiting revenue, credit income summary. Now, what about the expenses? We know that when we record an expense during the month, I debit the expense account and I credit cash or whatever. Recognize that the expense happened. I debit the expense account and credit either cash or accounts payable. What that does is it increases my expense during the month. But now here we are at the end of the month. I got to close out those expenses. So I'm going to do the opposite. I'm going to debit income summary, credit expenses, credit all the expenses. Debit income summary and credit all the expenses. Think of it like reversing it. Right? That's kind of what we're doing. We're taking the balance out of the expenses, putting it into income summary. That's the second step. Then, of course, the third step, we're going to close out income summary. Income summary is a temporary account. All I use that account for is to take out the revenue and take out the expenses. So now, I got everything sitting in income summary. So I need to close that out and transfer that to owner's equity here. In this case, owner's capital. It's the same thing. It's just a different name. It's the same thing. It's an equity account. We know that. So I'm going to take that balance of income summary, and debit it, and we're going to credit it to owner's capital. Step 3. Then step 4, subtract any withdrawals. That's it. And in that 4-step process, we closed out our temporary accounts. Questions? This is what it looks like visually. Questions? Quanda, did I do okay explaining this? Any questions at all?
No, this is Ronell. You did just fine. It was, the instructions are clear, and then the way that you described it, it was just very apparent. So I have no questions.
Great. Thank
I
you,
second
Ronell.
that.
Thank you so much. Makes me feel good. Thanks, Ashanti. Yeah, I appreciate that. Again, it's an important step of the process. Now, we've been talking about the accounting cycle for the past 3 weeks. 3 weeks. I mean, you may not have noticed that we've been talking about the accounting cycle for the past 3 weeks, but we have. Almost each chapter, we're kind of rolling on through it, And this is kind of rounding it out. And so that's why this part of the process is important. So this slide right here shows you visually what it looks like, right? We debit the revenue accounts. We credit income summary. That transfers the revenue over to income summary. And then we go through and we debit income summary and credit all the expenses. It transfers all our expenses to income summary. And then we apply the income summary balance to the capital balance or the equity account, right? Owner's equity account. Debit income summary, credit owner's equity. In this example, capital. Minus any withdrawals. That's it. Relatively simple process. This flow chart kind of helps us to put it in perspective. Again, closing out your temporary accounts is extremely important because you cannot start the next month with revenue and expenses already because the next month has not yet happened. According to the matching principle, we need to recognize revenue and expenses during the accounting period in which they were incurred. That's why it's so important that we go through the closing entry process. Now, after I've made my closing entries, I need to post them to the trial balance. So I do just like I did before in that worksheet. List out all the accounts, all my balance sheet accounts, all my income statement accounts. I list them out in order, yeah? According to the chart of accounts. List out all my permanent ones. Those are up my balance sheet accounts. And then I go through the post-closing entries, and I make sure that my debit column equals my credit column. That way I know I didn't make any errors. And this is an example of a post-closing trial balance for all my permanent accounts. Remember, they come from the balance sheet. And I see that my debit column equals my credit column. I did it right. So, the accounting cycle, this is what we've been doing the past few weeks. Call this the accounting cycle. Step 1 of the accounting cycle is analyze transactions. My friends, we did that back in chapter 1. Okay. We remember, it was kind of fast, I know, because that was a pretty busy class. But remember that first day of class 3 weeks ago? Of course you don't. I don't remember that either. But I can tell you, I know I'm kidding. I remember. We talked about this, analyzing transactions. Remember, there were like 24 examples I flew through. That was a process called analyzing transactions. Where do the account fall on the accounting equation? Cash, supplies, property, plant, equipment, all those are assets. If I have a transaction that affects one of those, I'm affecting the asset side of the accounting equation. The accounting equation is assets equals liabilities plus equity. Every transaction affects two accounts. It's usually an asset account and possibly a liability or equity account, depending on the transaction, right? We went through the first day of class, we went through about 24 examples of analyzing transactions. So step 1 of the accounting cycle. The following week, week 2 of this class, we talked about a couple of different things. We talked about how to journalize transactions, right? What account do we debit? What account do we credit? The amounts involved. I went through a lot of examples of those. That was the second week of this course. And we talked about how to post those transactions to your general ledger. Remember, the general ledger is like, we call it a T account, right? It has the name of the account on the top and then the balance below it. And it might be a debit balance or a credit balance, depending on what it is. And then the ending balance, right? So we covered step 2 and 3 in week 2 of this course. And then last week, we talked about a couple of other items, didn't we? Adjusted trial balance, I'm sure we talked about that. I know we talked about adjusting entries. So steps 4 and 5 of the accounting cycle we definitely covered last week. And I believe we even talked about steps 6 and 7, if I'm not mistaken. I know we went through the process. Last week we covered steps 4, 5, 6, and 7 of the accounting cycle. And just now we talked about steps 8, 9, and 10. Well, kind of 10, a little bit. It's optional, right? We talked about steps 8 and 9. How to do closing entries, doing the closing trial balance. So over the past 4 weeks, including today, we've completed the accounting cycle. This accounting cycle, this process that we go through every single month, by the way, without knowing it, we go through this step, all of these steps every single month. This accounting cycle is the foundation of accounting. This accounting cycle is everything. This is the blueprint of everything in accounting. Go through all 9, sometimes 10 of these steps. And that's the process. And then we do it all over again at the beginning of every single month and at the end of every single month. This is the accounting cycle. And it's great that you all got the chance to learn about this accounting cycle over the past 4 weeks in detail, because it really is that important. One thing that's optional is to prepare what's called a classified balance sheet. On a classified balance sheet, we separate current and non-current. Most balance sheets that you'll see use what's called the classified balance sheet format. The format works like this. Separate out current versus non-current. Long-term is what it's also called. Non-current can also be called long-term. For example, on the balance sheet, we know we have assets, liabilities, and equity. These are our permanent accounts. The assets can be classified as either being current assets or long-term assets. Current assets means less than 12 months. The word current means 12 months or less. The word current means 12 months or less. This would include things like cash. I expect to use some cash within 12 months or less. Inventory or supplies. I expect to use inventory or supplies within 12 months or less. Accounts receivable. I expect to collect my accounts receivable within 12 months or less. That's why they're called current assets. I expect to utilize them within 12 months or less. So your current assets include things like cash, accounts receivable, inventory, supplies. These are things I expect to use within 12 months or less. That's why they're current assets. Your long-term assets, also called non-current assets, would include things like property, plant, and equipment. Long-term. Expect to use them for a really long time. Long-term. We also call them fixed assets. Fixed assets are fixed. Not going nowhere. The building's there, it's fixed. The land is there, it's fixed. The equipment is fixed. Fixed assets. So, in accounting, I know it's a little confusing because accounting has been around over 3,000 years. Okay? Real long time. Because it's been around for so long, sometimes the terms, they make new terms over time. Yeah. Non-current assets, fixed assets, long-term assets, they're all the same thing. Accounting has been around for 3,000 years. So you might find some terms used interchangeably. The same with liabilities and equity. We can separate out, classify current liabilities and non-current or long-term liabilities. Current liabilities represent liabilities that I expect to pay within the next 12 months. This would include things like accounts payable, wages payable, taxes payable. The current portion of long-term debt. Oh, that's a new account, Dr. B. I haven't heard that one before. What's the current portion of long-term debt mean, Dr. B? Never heard that term before. So glad you asked. So, current portion of long-term debt means I expect to pay my car loan, which is 5 years long. I expect to pay the current portion of that. That's what current portion of long-term debt means. The current part is the most recent 12 months. The rest of it's long-term. For example, if you have a car loan that's 5 years long, the current portion of that debt is the first year. But remember, current liabilities means 12 months or less. See? We probably won't see that account too often, but I just want to let you know what it is. And non-current liabilities or long-term liabilities, notes payable. It's like a bank loan. Mortgage payable. Car loan payable, yeah. You see, long-term loans. It's non-current liabilities. Of course, you got equity. It's just equity. We don't distinguish equity being current or long-term. It's just equity. Here's an example. Here's what it looks like. You see, separated out current assets versus long-term assets. Also known as plant assets. It's another term for it. But you see current assets, everything to use within 12 months or less. Long-term investments. Plant assets, also known as fixed assets or non-current assets. So many terms. This is your property, plant, and equipment. Under liabilities, you got under liabilities, you have current liabilities and long-term liabilities. Your current liabilities, I expect to pay those in 12 months or less. Long-term, it's going to take me a little longer. Yeah. You see that in parentheses, it says net of current portion. Because current portion of long-term debt, the current part. I gave the car example, 5-year loan. First 12 months of that 5-year loan, that's called the current portion. Remember, 12 months or less is current. Fun stuff. Just to summarize, current assets, I expect to use within 12 months or less. Cash, inventory, supplies, 12 months or less. Accounts receivable, and I collect that money in 12 months or less. Your current assets. Long-term investments held for more than a year. Long-term, greater than 12 months. Example of this. If the company is planning to expand, we might purchase some land next door. We don't have plans to build on it yet. Company's small, okay? But I'm growing. I might use that land next door and expand on it, put another building. It's called a long-term investment. As long as I have that piece of land for more than 12 months, or plan to hold on to it for more than 12 months. Even if I don't use it, it's still considered a long-term investment because I'm going to hold on to it for more than a year. And of course, plant assets, also known as fixed assets, also known as long-term assets, would include things like property, plant, and equipment. And then you might also have intangible assets. These are also long-term. This would include things like copyright, patents, music, things you cannot physically touch. Yeah, intangible. And on the other side of the accounting equation, liabilities. Current liabilities, I expect to pay within 12 months or less. Account payable, wages payable, taxes payable. Current portion of long-term debt. I expect to pay these things in 12 months or less. Long-term liabilities. Greater than 12 months. Mortgage payable. Bank loan payable. Long-term, yeah. Greater than 12 months. And equity is just equity. Don't distinguish between current and long-term with equity. I promised you all a ratio. I'm delivering on that promise. This one's called the current ratio. The current ratio is a really important one to know. The reason why it's important is because this ratio tells me the company's ability to pay its current debt. If the company cannot pay its bills that are due in the next 12 months, that's a problem. The company's going to go out of business unless they get another loan. The company cannot pay its current liabilities and 12 months or less, that's a problem. How do I know if the company's having trouble paying its bills? I can compute what's called the current ratio. It's very straightforward, and all I need is my balance sheet to do this. Take my current assets, total current assets, divided by current liabilities. Current liabilities gives me the current ratio. This tells me the company's ability to pay its current debt. Now here we have an example at the bottom for Costco. Oh, I love Costco. They got great stuff there, don't they? Okay, so take a look here. Years ago, 1 year ago, and then the current year. Assets divided by current liabilities. So the current year is $17,317 million divided by $17,495 million. That's 0.99. Well, Costco. It's less than 1. That's a problem. It's not like horrific, you know. It's not that bad. It's not good. I want a number that's 1 or greater. 1 or greater. Because what this tells me is that they might have a little trouble because their current assets are less than their current liabilities. But that's why this ratio is important, because it helps us to identify those kinds of concerns. Or it just tells us the company's financial health. Yeah. It's a good one. Good one to know. That last step in the accounting equation, step 10. Yeah, I said it's optional because it doesn't always happen this way. Reversing entries. Sometimes we make mistakes. Okay? Sometimes we make a mistake. It's okay. It happens. Or sometimes you're a little off on something. It's okay. It happens. We can do what's called a reversing entry. Reversing entry is very simple. You're just flipping the debit and the credit. Okay? The accounts, you're just flipping them. You're reversing it. You're reversing the transaction. Okay? We do this when there's mistakes. That's why it's optional. Hopefully, we don't make mistakes. This is an example of that. Oh, I accidentally put an extra $210 in salaries expense. Whoops. It's supposed to go in the previous month. I accidentally put it in this month. Whoops. No problem. So I reverse it. The first transaction is debit salaries expense, credit salaries payable. I realized the mistake. And then to do that, I debit salaries payable, credit salaries expense to reverse it by the same amount. No one's perfect. Other examples of that same process. Yeah, you see, it's a nice way for us accountants to get out of trouble when we make a mistake. Reversing entry. Are there any comments, questions, or concerns at all about things like closing entries or anything along those lines? Anything I didn't answer that you hope that I would?
I guess for me, I have no questions because if I did, then right after you would introduce something, you would answer my question and then show the example. So no.
Thank you, Ronell. I appreciate that. I'm glad I was able to answer all your questions, Ronell. That's good. That means I did my job appropriately.
I agree. You're very straightforward and you make it easier to understand.
Awesome. Thank you so much. I appreciate that. Great, great. Laquanda, did I get everything that you and I were talking about the other day? No, we didn't really get a chance to much to talk about it, but hopefully I was able to answer your questions. So,
Yes, you answered my questions.
awesome. Very cool. Great. Thank you so much. Appreciate that. Great. Wonderful, wonderful. Okay, so just as a reminder about the homework for Thursday, Thursday, for Thursday's class, that's what I want you to do. In the classroom, I want you to respond to Chapter 4 discussion. This is a required discussion post. It's 5% of your grade. Please don't miss this opportunity. Here's what we got, my friends. I need you to answer these 3 questions. Why are closing entries prepared? Why do we use income summary when preparing closing entries? Why are closing entries prepared after the financial statements? To help you to answer these 3 questions using full paragraphs, I would like you to use your textbook, use your notes, PowerPoint presentation, today's lecture, outside resources, anything on the internet, totally fine, absolutely. Just make sure that you write in full paragraphs, you use citations and references. Very important that you do this. Once you've done your original post, hopefully this Thursday night during class time, you've done your original post, then please go back to this discussion board and respond to 2 of your classmates with full paragraph responses. Don't just put nice job. No, none of this one sentence stuff. That is not substantial. That's not going to work. I'm expecting full paragraph responses as well. To show you the example, Tamara did a wonderful job here. Got 3 paragraphs. Very well done. Okay. In-text citations, reference. Very well done, Tamara. Yes, very, very good job. And then, Nikita, yes, this is great. I see the 3 paragraph responses to my 3 questions and a reference. Very good job. It's okay. Don't worry about the in-text citations. It doesn't have to be perfect. It's okay. I'm not looking for perfection. I'm just looking to make sure it's done. And then the responses. Nikita responded to Tamara's post. Perfect. This is exactly what I'm looking for. This is a full paragraph, y'all. Full paragraph responses. Perfect. Now all Chiquita has to do in order to complete this discussion is to respond to one other person. After that one other person makes their post. So what are we looking for? Thursday, I want to see your original response to these 3 discussion questions. Full paragraphs, citations, references. And then by Sunday night, I want to see that you've responded to 2 of your classmates. Responses are required. Okay, that's how you get full credit. Any questions at all about the required discussion post? Post, plural. Questions about the homework?
I think we're good, Professor.
Thank you, Ashanti. Appreciate it. Okay, y'all. If you need anything, if you ever need anything, you can always email me, call me, set up office hours. I'm here for you all the time. That's a promise. Okay? I'm here for your success. I'll always be here for your success. I want you to know that. I appreciate your hard work. I really do. If you need anything, email me, call me, set up office hours, whatever you need. I want you all to stay safe, wash your hands, do the right things, and I'll see you all again next time. Thank you so much for your time today. I appreciate all of you. Have a wonderful,
Thank you,
wonderful
Professor.
night. Yes, please.
Thanks, Professor.
Thank you.
Good